So first question, why does someone need a mortgage pre-approval?
Mortgage pre-approval is a scenario where if you're a buyer and you're going around shopping around for a home, having a mortgage pre-approval gives you an idea that you can actually get financing or that purchase price that you're going in is actually something that you can afford. Imagine going into a home that's worth $1 million and you fall in love with it, and then you go see the bank and you go, well, I'm in. $1 million home definitely is very nice, very beautiful, but you can only afford $900,000. 900,000 is still a good number, but there's a reason why it's $100,000 less. So it sets yourself up for disappointment when you go and shop and you don't know whether or not you can afford it. Now, when I say you can afford it, obviously it means that we've gone through the process of saying, "Hey, I'm in. How much is your income? What kind of debts do you have?" So that's the liability part. What kind of assets, so down payment sources you have access to, and then lastly, once we figure out how much you can afford, how good is your credit, and then tell me about the properties that you're interested in. So on a mortgage pre-approval, we look at your ability to pay your financial responsibilities, and then we look at your credit history that says, hey, you're likely to pay your financial responsibilities. So we qualify your documentations up front so that when you go shop for the right price that you got it qualified for, the only missing piece is the property. So the pre-approval sets you up to put in an offer that you can qualify and get approved for. And then obviously the last thing the lender just has to qualify is the house, the townhouse, the condo that you bought.
So just to clarify, for anyone who is
Yep.
buying a property for the first time, when you go in with your pre-approval, that means yes, for sure you are able to get that amount. So there's no chance that they'll get that mortgage pre-approval, go out there, put a firm offer in somewhere, no conditions because they already have that letter. They know they're approved for that 900,000, let's just say. And then when they go to close the deal, you're not going to come back to them and say, "Oh, you know what? It's been a week or two. The bank has changed its mind. You're only approved for like 800,000," right? There's no chance.
So there is a chance because the question mark is the property. Yeah. So when we see purchase agreements without any condition of financing or with basically clean offer, as you mentioned, technically you're the buyer. As a buyer, you're still taking a chance that that property that you bought for 900,000 that was originally listed for 800,000, so it's $100,000 over asking. You're taking a chance that that $900,000 property that you bought can appraise for 900,000. So there is still that question mark. So lender can qualify you on the pre-approval in terms of, again, your ability to borrow, right, as a covenant, but not necessarily the security, the property yet. Because once you have the property, now it's a mortgage approval, not a mortgage pre-approval. So there's a chance. So there's a level of risk that when you buy something without any condition of financing, but that's where you go and make your own call as a buyer to say, if I bought it for $900,000, do I have comparables? Can I justify that amount?
Ray, are you at all concerned? Because we know with the market right now, places are overbidding, overselling like never before, right? It's like some places are appreciating like 30%. And within a year, places that we've never even really been to. Are you or your clients concerned that once things reopen, let's say somebody got, I don't know, like a pre construction, or let's say they did buy something and they go in for the appraisal, let's say all of a sudden the market corrects, and now that 900,000 home in little town Ontario isn't being appraised for that, it's actually going for lower, what happens in that scenario?
So yeah, the answer is yes, only because for the longer closings that you mentioned, the market can turn from the time that you buy to the time that the property closes. There's also a scenario where, every single home that's being bought today is the highest sold price on the street. It's great for marketing if you're a realtor and listing agent and stuff because you're able to get as much money as you can for your client. But on the buying side, it obviously is a little bit of a concern because if it's $100,000 over asking, $200,000 over asking, would the financial company be able to justify that amount? Now, there's a scenario where you can overpay by a little bit and you still be able to withstand that increase. So if you're putting 50% down, on the purchase, and there's $10,000 difference between 900 to an appraisal amount of $890,000, I may be able to make some adjustments and go work with the lender and say, hey, let's adjust the loan to value, and Amin can still get the money that she's looking for. But when you're looking at new build properties where the closing is a year, 2 years down the line, there could be a different market. Now, one of the things that we do with our team is to make sure that when we see a resale purchase, that we order the appraisal right away. Because if you're familiar with what's happened in the past or could happen, is that if you buy today, we get you approved, and then we wait until a month or 2 months after to order the appraisal. A month from now, if the market turns, now if it goes up, everybody's happy. But if that price goes down, you might be exposed, or we might be exposing the clients to more down payment requirement, and they
Okay.
may or may not have it, right?
What are you? I don't know if you're getting clients talking about this, but we know, depending on what type of property people are buying, like if they're buying a home, I think people are banking on it's going to just keep appreciating. However, the condo market has surprisingly taken a hit everywhere. So for people that bought pre-construction, they might have got their mortgage approval when they signed the contract. So maybe it's a year, year and a half. Let's say those projects are not coming up for close this year or maybe early next year. And now the condo market has obviously taken a hit. So what happens then in that situation?
We haven't seen that significant decrease yet. We've seen the January and February numbers for Toronto condos have actually recovered quite a bit. Now, if it's a hypothetical scenario where your particular purchase may have a decreased valuation, like I said earlier, it might be a scenario where we have to go back to the client and say, I mean, you need to come up with another 5% or 10%, because if we want to purchase this as your primary residence or a rental property, you need to be able to afford that borrowing that you're borrowing for. And part of what we look at is the value of the property, right? So if you bought it for a condo for $700,000 and now it's worth $600,000, it's a $100,000 difference. Obviously, you may want to, at the worst case scenario, you may want to expect to put another $100,000 as additional down payment. Now, that's a worst case scenario. We haven't seen it though in reality, only because condos are typically, 3 year to 4 year closes. So if we're in 2021, you probably have bought this in 2017, let's say, maybe 2016. So because of the period of time, it still has increased. So we haven't seen such a drastic decrease in price, or it hasn't reflected current market as far as new condos are closing today. Now, 2022, you said, if there is an adjustment, we just have to deal with it from either a higher down payment scenario, or may even be graduating you or putting you down to maybe a B lender instead of an A lender.
Okay. But for anyone that's concerned about that, if they go to you, you will be able to help them get the financing, right? They're not going to be in a situation where there's nothing they can do and they won't get approved.
There's different levels of financing that's involved, and obviously the A lender, which are the banks, the big financial institutions that we deal with, will get the best rates, under 2%, all the features that you can prepay it and you increase your payment and all that stuff that you would want as a borrower. That's our ideal scenario. Now, if you are faced with a little bit of a challenge, whether or not it's pandemic driven or prices of homes, we do have B lenders and private money that's available. But as we move down to the B lenders and private money, I'm going to say it's costing the clients more money, higher interest, maybe fees.
I'm glad you mentioned that because I do think people do get kind of misunderstood of what kind of lenders they are. They think, oh, I'm getting money from a bank, but there are different types of financing. So I'm glad you touched on that.